Every time you check into a branded hotel, you're standing at the intersection of three separate businesses, each with its own income statement, its own risk exposure, and its own relationship to the revenue your room rate generates. The sign on the building belongs to one of them. The real estate underneath belongs to another. The company actually running the front desk, the housekeeping, and the food and beverage operation may belong to a third. Understanding which of these three entities you'd actually be participating in, if you ever put capital into a hotel, is the entire economic question this video is built to answer. Before any specific numbers appear, one honest note. This is an educational breakdown of hotel industry economics, business models, and investment structures, not investment, business, legal, or financial advice. Hotel ownership economics vary significantly by property type, location, market conditions, brand, and operational execution. All financial figures cited to public company earnings releases and SEC filings are sourced to those documents. Individual property performance will differ materially from any illustrative calculation presented here. REITs mentioned in this video are publicly traded securities and past returns are not predictive of future performance. AAHOA statistics referenced come from AAHOA's own published economic impact study conducted in partnership with Oxford Economics in 2021. Fee percentages cited reflect published franchise disclosure documents rather than estimates. Let's establish the scale of what we're discussing. According to AHLA, the American Hotel and Lodging Association, the U.S. hotel industry alone generated approximately $236 billion in total revenue in 2024, supporting around 8.5 million jobs. Global hotel supply as tracked by STR and Statista sits at roughly 700,000 properties. This is one of the largest real asset categories in the world. But its ownership structure is far more unusual than almost any other real asset category you could name, and that unusualness is precisely what makes understanding it valuable. Here are the three entities. The brand, Marriott, Hilton, IHG, Wyndham. The owner, the entity that put up the capital, holds the real estate, and carries the debt. And the operator, often a third-party management company hired to run day-to-day operations on behalf of the owner. These three entities share one pool of revenue generated by the hotel's rooms, food and beverage, and ancillary services. But they extract value from very different positions in that revenue stack, at very different risk levels, and with very different results on their respective income statements. The shared language all three use to track performance runs through four metrics you need to understand before any of the economics make sense. ADR, average daily rate, is total room revenue divided by rooms sold, the price per night the hotel is actually realizing across its occupied rooms. Occupancy rate is rooms sold divided by total rooms available, the capacity utilization figure. RevPAR, revenue per available room, is ADR multiplied by occupancy rate, and it is the primary KPI for revenue management and competitive benchmarking. A hotel with an ADR of $150 and 65% occupancy has RevPAR of $97.50. And GOPR, gross operating profit per available room, is the actual profitability metric that reflects all operating costs, not just revenue. This is what the owner actually lives on. RevPAR is what the brand measures. GOPR is what the owner spends. These two numbers can diverge significantly, and that divergence is where the economic tension in this entire industry lives. Let's build the capital structure from the ground up using consistent, realistic inputs, so the math is fully visible from start to finish. Picture a 100-room upper mid-scale hotel, the category that includes brands like Hampton Inn, Courtyard by Marriott, and Hyatt Place. Construction cost for new development in this segment runs roughly $150,000 to $250,000 per room, depending on market and land cost. On a 100-room property, that's $15 to $25 million before a single guest checks in. For an acquisition of an existing property, you may pay a lower per-room capital figure, but you're purchasing an established asset, often with deferred maintenance already accumulating against you. The moment the brand flag goes up, the fee stack activates. Inside this first layer, the franchise royalty fee. Published Hampton in franchise disclosure documents, required by the Federal Trade Commission, disclose royalty fees of approximately 6% of gross room revenue. That 6% is paid on the top line, not on profit. Whether the hotel made money last month or not, the royalty check goes out. Inside the second layer, the brand's program services contribution, covering marketing, reservations infrastructure, and technology. Add 4 to 5% of gross room revenue. Combined with the royalty, you're now looking at approximately 10 to 12% of every dollar of room revenue going to the brand before you've paid a single employee. Inside the third layer, if you've engaged a third-party management company to run operations, their fee runs approximately 3 to 5% of total revenue. Not room revenue. Total revenue. Inside the fourth layer, OTA commissions. When a guest books through Booking.com, Expedia, or Hotels.com, the platform collects a commission of roughly 15 to 25% of the booking value. The exact OTA share of bookings varies by property and location, but a mid-scale hotel without strong direct booking infrastructure can see 30 to 50% of its reservations sourced through OTAs. Apply a 20% commission to 40% of bookings, and you're losing 8 cents on the dollar of total room revenue before labor touches the income statement. Labor accounts for approximately 34% of total hotel revenue on a national basis, according to AAHOA industry data. This is not an optional cost. Hotel operations are fundamentally labor-intensive, and the labor floor is structural. After royalties, program fees, management fees, OTA commissions, and labor, the remaining margin must absorb utilities, insurance, maintenance, property taxes, and debt service. STR's 2024 year-end data for the U.S. upper mid-scale segment shows average RevPAR in the approximately $73 to $82 range depending on location tier. On an average nightly room rate and occupancy at that RevPAR level, the fee and cost stack we just built makes the path to a healthy owner margin narrow. Not impossible. Narrow. Now here is the cost hiding in the franchise agreement that most prospective buyers don't fully model before signing. Every franchised hotel is subject to periodic property improvement plan requirements, mandatory renovation obligations specified by the brand to maintain flag eligibility. These are not negotiable items. Failing to complete a PIP means the brand terminates the franchise agreement, which means you own an asset generating revenue under a brand it no longer has the right to use. PIP costs according to hotel advisory firm HVS and industry documentation rose significantly following the pandemic supply chain and construction labor disruptions. A mid-scale to upper mid-scale PIP typically runs $10,000 to $35,000 per room depending on scope. On a 100-room property, that is $1 to $3.5 million in capital expenditure, recurring approximately every 7 to 10 years, regardless of whether the property was otherwise performing well. This is not a surprise for experienced operators. It is a structural feature of the franchise model. What catches newer owners is the timing. The PIP clock starts the day you take ownership, and the clock does not care about your financing schedule. Now let's flip the perspective entirely, from the owner's income statement to the brand's, because the numbers on these two P&Ls look nothing alike. On the left side of this comparison, Marriott International's financial structure. On the right side, a typical franchised hotel owner's financial structure. Both are connected to the same physical hotel. Both are receiving or paying fees based on that hotel's revenue. But the income statements look fundamentally different from each other. Marriott International's 2025 annual report, filed with the SEC, reports adjusted EBITDA of $5.38 billion, up 8% from 2024. That figure is generated from a portfolio of approximately 9,400 properties globally, the majority of which Marriott does not own. For Marriott's fourth quarter of 2025 alone, franchise and base management fees totaled $1.186 billion in a single quarter, sourced to Marriott's Q4 2025 earnings release. Hilton's publicly filed ownership data shows approximately 97% of its 9,000-plus properties are franchised or managed rather than owned outright. Here is the structural fact that sits at the center of the entire asset-light model. Marriott's fee revenue is calculated as a percentage of gross room revenue at each franchised property. It is not calculated as a percentage of net income. A hotel that generates $5 million in room revenue and loses money on operations still generates $300,000 to $500,000 in fee income for Marriott. The brand's interest and the hotel owner's interest are partially aligned, because higher revenue means higher fees. But they are structurally decoupled at the profit level. The brand earns on the top line. The owner earns on the bottom line, if anything is left there. This decoupling is the intellectual core of the entire asset-light model. Marriott's EBITDA trajectory, following this line from the pandemic trough upward, has grown in parallel with its fee revenue as the brand's franchise count expanded. That growth required almost no capital deployment by Marriott into the physical real estate. Every new hotel added to the portfolio is capitalized by the franchise owner. The brand adds a revenue stream at negligible marginal cost to itself. The loyalty program extends this advantage further. Marriott Bonvoy, as of Marriott's most recently published filing, has over 228 million members. Marriott holds co-brand credit card partnerships with JPMorgan Chase and American Express. Hilton holds a co-brand partnership with American Express. Per Marriott's Q1 2025 earnings release, the company explicitly attributed fee growth in part to higher residential and co-brand credit card fees, revenue paid by the card issuer to the brand for each active cardholder earning and spending points. This is a third revenue stream for the brand that operates entirely independently of any individual hotel property's performance. The card partner pays the brand. The brand collects. Whether the hotel in Dallas had a soft occupancy month has no bearing on it. There is a third way to participate in hotel economics that almost nobody in consumer finance content mentions, and it is the path that most institutional capital and most informed individual investors actually use to access this asset class. Hotel real estate investment trusts are publicly traded vehicles that own portfolios of hotel properties while contracting day-to-day management to third-party operators. The REIT structure, under U.S. tax rules, requires distributing at least 90% of taxable income to shareholders as dividends, which produces a regular income stream from the underlying hotel cash flows. Inside this bounded investment vehicle, the investor owns fractional interests in physical hotel real estate, receives dividend income from portfolio operations, and retains public market liquidity, meaning the position can be bought or sold on any trading day through a standard brokerage account. Zoom into the largest hotel REIT in the United States. Host Hotels and Resorts, trading under the ticker HST, owns a portfolio of primarily upper-upscale and luxury hotels, including properties under the Marriott, Westin, and Hyatt flags, while those properties are managed by the brands themselves. Apple Hospitality REIT, ticker APLE, owns a select service portfolio concentrated in Hampton Inn and Hilton Garden Inn properties across multiple U.S. markets. Park Hotels and Resorts, ticker PK, holds a portfolio of upper-upscale convention and resort properties. Sunstone Hotel Investors, ticker SHO, focuses on urban and resort markets. Compare these two paths side by side. On the left, direct franchise ownership of one hotel. Full capital exposure to one property, one location, one market, one physical asset with full operational responsibility and personal liability for debt service. On the right, ownership of a fractional interest in a professionally managed portfolio of many hotels across multiple markets through a REIT. Portfolio diversification across markets and property types, professional institutional management oversight, public market liquidity, and regular dividend income from aggregate portfolio cash flows. The trade-offs are real. A REIT investor has no control over individual property decisions, no franchise ownership advantage, no ability to add operational value through their own execution, and is exposed to broader real estate market volatility and public equity market sentiment in ways a direct property owner is not. But for most viewers of this video, the RAT structure is the most accessible form of exposure to hotel real estate economics, and it is completely absent from virtually all consumer-facing content on this topic. If the layers of this industry, the brand economics, the owner economics, and now the RAT structure as a third path, are giving you a genuinely new framework for how you think about this asset class, subscribing keeps the continuation of this series in your feed. Now let's examine the model that produced more U.S. hotel wealth than any other approach, not by following the franchise playbook as written, but by understanding its mechanics clearly enough to use it selectively. The Asian American Hotel Owners Association, AAHOA, in partnership with Oxford Economics, published a comprehensive economic impact study in 2021. The documented findings: AAHOA members own approximately 60% of all hotels in the United States, representing roughly 34,000 properties. The community that produced this ownership share constitutes less than 1% of the U.S. population by census data. Approximately 70% of Indian American hotel owners share the surname Patel, documented in AAHOA's own institutional history and confirmed in multiple academic and industry sources. These are facts about a business strategy, not cultural observations, and the business strategy itself is what this section is built to explain. Phase 1 of the model begins with the first property. Typically an economy or budget motel, often independent of any brand. The owner lives on the property. The family covers positions that would otherwise require hired labor, the front desk, maintenance, cleaning coordination. No management company fee. No off-site payroll for functions that family members absorb directly. The labor cost structure that accounts for 34% of revenue in the industry average looks different when the people doing the labor are not collecting a separate paycheck. The cash flow generated by even a modest, independently operated economy property accumulates faster under this structure than it would under a fully staffed, brand-managed model. Moving to Phase 2. The accumulated cash flow from the first property finances the acquisition of a second. This is where the brand relationship enters, but on different terms than the investor who buys a single franchise as a financial asset. The brand flag on the second property, a Hampton Inn, a Comfort Inn, a Holiday Inn Express, activates the brand's reservation system, which channels bookings directly rather than through OTAs at OTA commission rates. The brand is used as a distribution tool. The franchise fee is paid, but the OTA commission reduction it enables is part of the strategic calculation. Moving to Phase 3, multiple properties. Here is where the vertical integration that changes the per-unit economics begins to materialize. Shared laundry infrastructure across several nearby properties. A shared maintenance crew instead of property-by-property contractors. Shared back-office accounting. The fixed costs that each individual property carried independently are spread across the portfolio. Each additional property acquired becomes cheaper to operate per unit, not because the physical costs of running a hotel changed, but because fixed costs are amortized across more revenue-generating assets. Phase 4, the generational transfer. U.S.-educated second and third generation family members, many with hospitality management, real estate finance, or construction backgrounds, enter the enterprise that the first generation built from a single economy motel. AAHOA documents that second and third generation operators have moved into upper upscale development, new construction, and markets requiring significantly more capital and sophistication than the initial entry point. The portfolio that started with one family-operated budget motel has compounded over decades into institutional-scale ownership in some cases. The economic engine is not a single insight. It is the combination of scale, owner-operator convergence that eliminates the management fee layer, vertical integration that reduces per-unit operating costs, the brand used as a distribution tool rather than as an operational dependency, and generational capital compounding across time. Each element by itself is ordinary. Combined and applied consistently across multiple properties over multiple decades, the documented result is 60% of U.S. hotel ownership from less than 1% of the population. Let's answer the question the title posed. What are the economics of owning a hotel? The answer has three distinct versions depending on which position in the structure you're occupying. As a franchised owner of a single property, the math is challenging in a specific way. The brand, management company, and OTA layer together absorb a substantial portion of gross room revenue before you reach labor and fixed costs. The business works when RevPAR performance is strong and when the owner manages operationally with discipline. But one property means one location risk, one PIP cycle, and one income statement that must carry every cost without the portfolio diversification that improves resilience. This is not an argument against single-property hotel ownership. It is an accurate description of what that position requires and what it costs. As a scale owner applying the operational and capital compounding model documented by AAHOA, the math changes in measurable ways. Eliminating the management fee through direct owner operation removes 3 to 5% of total revenue from the cost stack. Shared infrastructure across multiple properties reduces per unit operating expense. The brand is used to access the reservation system rather than relied upon for every operational input. Scale achieved through acquisition and reinvestment compounds the portfolio's cash flow generating capacity over time. The economics of this position are different, not because the franchise agreement changed, but because the ownership structure and operating model changed around it. As an investor in the brand itself through publicly traded equities, or in hotel real estate through a REIT structure, you access hotel economics through the most capital-efficient position in the structure. The brand collects fees on the top line regardless of property-level profitability and has demonstrated the ability to grow adjusted EBITDA, as Marriott's 2025 filing shows, while deploying essentially no incremental physical capital into the properties generating those fees. The hotel REIT diversifies across many properties with professional management, distributes portfolio cash flows as regular dividends, and maintains public market liquidity. Neither position involves the operational grind or concentrated capital risk of direct single property ownership. The synthesis is not that you should not own a hotel. The synthesis is that the economics of each layer of the hotel industry are fundamentally different from each other, and entering any one of them without understanding all three means you're making a capital allocation decision with incomplete information. The person who understands all three layers sees what each position actually costs, what it actually earns, and what it actually requires from the person occupying it. The same brand versus asset split we've examined in hotels replicates across virtually every major franchise industry in the United States: fast food, convenience stores, auto dealerships, fitness brands, urgent care. The mechanics are different in the details. The structural question is the same. Which layer of the economics are you actually entering, and what are the real terms of that entry? That comparison is the next conversation.